Yesterday morning, Nvidia and 6 of the most powerful firms in finance announced a plan to raise $500 billion for AI infrastructure. Blackstone, BlackRock, KKR, Apollo, Brookfield, Goldman Sachs. Jensen Huang said he approached exactly 6 firms, and none of them turned him down. Buried in the structure is the detail that matters. Much of that $500 billion will be lent against the chips themselves. The GPU in the data center becomes the collateral, the way a building backs a mortgage. Huang called it, quote, the first time that technology chips have become an investable asset class. Wall Street has securitized houses, cars, airplanes, and song catalogs. As of yesterday, it is securitizing compute. Today we open up how this machine actually works. First, the structure, because the headline gets it wrong. This is not one $500 billion fund with Nvidia's name on the door. Each firm builds its own independent financing platform, and each platform connects institutional money, pensions, insurers, sovereign wealth funds, to companies building AI infrastructure on Nvidia hardware. Nvidia says it may support up to 25% of the financing in a given deal, but the design's point is that the world's largest credit investors underwrite the rest on their own. It is a franchise system, 6 licensed dealers, each raising and lending its own capital, all of it ultimately flowing toward the same product line, sold by the one company that convened the group in the first place. Here is the mechanical heart of it. A data center operator wants 10,000 new GPUs it cannot pay cash for. A special purpose vehicle is created, a legal box whose only job is to own those chips. The SPV borrows the money, buys the hardware, and the chips plus their rental contracts become the collateral. Investors buy bonds issued by the box, and single issuances could reach tens of billions of dollars at a time. If the operator fails, lenders seize the box, not the company, and the pitch is that the chips inside are liquid. They can be re-rented or resold to someone else who needs compute. BlackRock's Larry Fink is already selling the paper as high credit quality with attractive yields. The first deals are expected to hit the market within months. That is the machine. Nvidia does not lack demand. It lacks customers who can keep paying cash. AI infrastructure spending is running toward $750 billion this year, and the easy sources are tapped. The hyperscalers have levered up. Meta moved to $7 billion of data center debt off its balance sheet. SoftBank borrowed against ARM because banks would not take OpenAI stock as collateral. And Nvidia's own commitments have piled up. Talks over a backstop of up to $250 billion for OpenAI's Ohio data center campus, another $350 billion in chip financing discussions, a $500 billion project with Korea's SK Group. Skeptics tallied roughly $750 billion in Nvidia-linked deal talk by late July. Yesterday's announcement is where the outside money for all of it is supposed to come from. One company has been the test lab since 2023. That August, a crypto miner turned AI cloud called CoreWeave borrowed $2.3 billion from Magnetar and Blackstone using Nvidia H100 chips as collateral. 3 years later, CoreWeave's total debt has passed $21 billion, up from under $8 billion in 2024. And this spring, the experiment graduated. In March, an $8.5 billion GPU-backed facility became the first ever to earn an investment-grade rating, A3 from Moody's, built on a bankruptcy remote SPV that owns the chips. In May, a $3.1 billion facility became the first that public market investors can actually trade. Yesterday's announcement takes CoreWeave's science project and offers it to the entire industry at 40 times the scale. Here is how the paper gets sold. Huang's exact framing. These are revenue-generating assets now. They are productive, they are long-lived. They are fungible, they are flexible. Translation, a GPU earns rent like a toll road collects tolls, so lend against it the way you lend against a toll road. The pitch has substance. The chips are rented under multi-year contracts to the biggest companies on Earth. Compute is genuinely scarce. H100 rental capacity has run tight for 3 years. And unlike a building, A chip can be re-rented to a new tenant anywhere on the planet in minutes. Squint, and it really does look like infrastructure. Exactly what pensions and insurers are starving to buy. The problem is what you see when you stop squinting, because one word in Huang's pitch is doing more work than any other. Long-lived. A toll road earns for 50 years, a bridge 100. An AI chip is economically obsolete in roughly 3 to 5, and not because it wears out, it gets outrun. When Nvidia launched its Blackwell generation, resale values for the previous H100 cratered, and rental prices followed. Now hold that fact next to the structure we just described. The collateral securing this $500 billion is destroyed on schedule by the product roadmap of the very company that organized the lending program. Nvidia ships a new architecture roughly every year. Every launch event is also, quietly, a write-down ceremony for the collateral backing the last vintage of loans. Lenders model aggressive depreciation curves, but the bet is that rental income outruns obsolescence. Every vintage. On time. For decades. Now step back and look at the shape of the flow. Nvidia invests in OpenAI and Anthropic, its largest end customers. Nvidia discusses backstopping OpenAI's data center debt, and now Nvidia convenes the 6 firms whose lending will finance the purchase of Nvidia chips. Money flows out from Nvidia, circles through customers and lenders, and comes back as revenue. The polite term is ecosystem financing. The impolite term, the one skeptics have used all summer, is circular. When demand is funded by the seller, reported demand stops telling you how much organic appetite actually exists. That is why, on the day Nvidia announced $500 billion of new buying power for its own products, the stock did not rise. It fell about 3%. The market has seen this movie. Because there is a movie, and it played in 2000. Telecom equipment makers, Lucent, Nortel, Cisco, faced customers who wanted gear faster than they could pay for it. So the vendors lent them the money themselves. Vendor financing across the industry hit an estimated $25 billion, and for a while it was beautiful. Every loan became booked revenue. Revenue drove the stock funded more lending. Then the dot-com customers started failing, and the vendors discovered they had not been recording sales. They had been warehousing their own risk. Lucent alone wrote off billions. Its stock lost over 98%, and 100,000 jobs followed. 25 billion then. 750 billion in Nvidia-linked commitments now. The structure, seller-funded demand booked as growth, is the same shape. The 2001 unwind hit tech shareholders. This time, the structure points somewhere else. The bonds these SPVs issue are built for institutional buyers, pension funds, insurance companies, retirement money, the money Apollo, Blackstone, and BlackRock manage for ordinary savers. That is the deeper meaning of yesterday. AI hardware risk is migrating off Silicon Valley balance sheets and into fixed income portfolios, wrapped in the language of infrastructure. But note the spread. CoreWeave's GPU debt spans investment-grade A3 on one facility and junk-rated BB+ on another, for chips from the same vendor doing the same work. When the same collateral supports both ratings, the rating is doing a lot of talking. Larry Fink says high credit quality. In 2006, the phrase was A or A. Now the honest other side, because this is not automatically 2001. The bulls need 3 things to be true. First, AI revenue has to keep growing into the capex. OpenAI's annualized revenue reportedly doubled in under a year, and if that continues industry-wide, today's chip rents get paid with room to spare. Second, the chips have to stay productive past their frontline years, and older GPUs do keep earning on cheaper workloads. Third, the contracts backing these loans have to hold, and most are signed by the most creditworthy companies alive. If all 3 hold, this is what financing a real industrial build-out looks like, the way railroads and power grids were built on paper just like this. The watch items have dates. CPI tomorrow, Nvidia earnings August 26th, and the first SPV bonds pricing within months. So here is the machine economy red. Booms do not announce their phase transitions, but they do leave fingerprints, and the fingerprint to watch is what borrowed money is for. When debt funds capacity that demand is already straining against, it builds empires. When debt funds the demand itself, when the seller has to arrange the financing that keeps its own order book full, the machine has started feeding on its own exhaust. Yesterday's announcement contains both possibilities in a single press release. And nobody, including Jensen Huang, knows yet which one it is. The chips are now collateral, the paper is now tradable, and the risk now has a forwarding address, quietly printed on a pension statement. When the first GPU-backed bond prices this fall, we will read it here. Subscribe, and we will keep the receipts.